Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:15 a.m. Central Time, and I'm recording this in preparation for the market day of October the 27th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's see what happened in the overnight. And pretty mixed. At the time of this cut, the S&Ps were down about 2.25 points on the futures, just marginally down. Russell was up marginally. NASDAQ, like the S&P, and the Dow were both also marginally down. Crude oil was down more significantly, down 1.2%. Euro, scratch. Bonds, scratch. Gold, scratch. In overseas action, China also essentially scratch, as is Hong Kong, though Japan was down much more significantly, down about 1%. Germany, scratch. United Kingdom, down about 0.38. In terms of macroeconomic reports, for the U.S., we have core durable goods and consumer confidence are the primary reports that you'll hear people talking about today and could move markets. Keep in mind this consumer confidence report comes out during the market, cash market open. So that could roil things around. Tomorrow you have the usual Wednesday crude oil inventory, trade balance also, and then the big one, FOMC statement, along with the federal funds rate. So that's probably what the market's kind of been sitting sideways about, is waiting for this clarity to come in. And obviously most of the analysts are thinking that there'll not be a Fed funds rate increase, but of course the market could react, in any way. It's very difficult to know how the market will react to such things. Sometimes you think that they get what they want and then they still go crazy, and then other times they get surprised and don't go crazy. So very, very difficult to take positions right in front of an FOMC statement, and I think you're seeing that reflected by the institutional involvement here in front, where we've got basically a very, very sideways and inside range market. Indeed, let's go ahead look at that chart. Let's start with the SPX. From one of the things I read this morning, the S&P entered a new bull market on Friday, but most of its stocks did not. Bull market is a term that is subjective, but here we're using the simplest test of a close above its 200-day moving average. While the S&P closed above that average for the first time in months, more than 50% of the stocks in the index were still below their own 200-day averages, the second worst showing since 1990. So breadth is also important, and we've been talking a fair amount about breadth in recent weeks. We talked about up here when this was topping pattern was in place, that breadth and the advanced decline and other measures were really poor, and this was not a surprise. We were looking for this action to break down. What's important now, of course, is what has breadth been doing lately? Well, indeed, we did see some improving breadth during this phase here. Institutional involvement was clearly improving, though perhaps not strong, but was clearly improving. Well, as we've come back up and come back into this prior range, we've seen that breadth indicators have started to decline once again. So the bulls may be running out of something of momentum at this point. And indeed, this little pattern here is a potential reversal pattern. It needs confirmation, and it certainly is not a very strong pattern. But we might see something of a pullback. Now, of course, new information will come into the market with the FOMC announcement, and this may indeed be more of a mark of indecision than it is really about reversal. And indeed, if the market likes what the FOMC does, it could very easily take off to the upside as a direct result of that report. In terms of the Russell, of course, it's been relatively weaker and is still yet to clear, a significant resistance area. So it's way behind the SPX. Now, I've heard some talk recently about, that the Russell, many people expect it to lead, and certainly I would say that I'd like to see that the Russell and the NASDAQ are leading to be able to couch it as a kind of a strong bull market. But the fact that the Russell is not leading up doesn't necessarily mean that the S&P will roll down. And so sometimes it's important to understand these nuances, that just because the Russell's weak doesn't mean the S&P turns. That's like your small cousin, forcing your big thuggish cousin to turn and change ways. Well, that doesn't necessarily happen. But certainly strong bull markets are usually indicative by having strong Russell performance, which are their small cap growth oriented companies, as well as strong leadership from the NASDAQ with its tech oriented higher beta stocks that characterize so much of the NASDAQ. So Russell definitely not helping the cause for the bulls. As the NASDAQ goes, obviously you had, there are some big players. When you talk about Google and Amazon, they're very, very, very heavily weighted in that NASDAQ. And when they come in with good earnings reports, you see this kind of action, and they just flat gapped and took this up to near all-time highs on the NASDAQ. So this is really not, frankly, a reflection of healthy tech sector as it was a good earnings report on the back of two very large components of the NASDAQ. But still, obviously, as the index goes, that's a very bullish action. It's very strongly positioned. So we'd like to see some healthier breadth by the various components of the NASDAQ to put more weight onto that. But certainly it's separated itself from the Russell, and you really don't call this so much a laggard anymore, but just kind of caveat that with the fact that this was done on the back of a couple components. This also can happen with the Dow. For example, last week we had McDonald's really take off, and one big component of the Dow can really push that index as well. Relatively stronger here as well, and it's back up into the prior range. So you have the S&P and the Dow, as well as the NASDAQ, that have pushed up nicely into prior ranges. Both the Dow and the NASDAQ, with those caveats that maybe not wild and wide participation, but oftentimes these breaches start with the action of one or two big companies, and then the others start to follow. So again, we continue to see healthier situations develop, and for the bears, continuing deterioration of their indicators. In terms of current volatility, the VIX is at 15.2. We actually saw something of a pop, not a big pop, but something of an elevated level with the short-term VIX and other volatility measures. Short-term VIX at the 15.20. And that wasn't really in line with the price action yesterday. Price action was just marginally down, nothing of any significant, and yet we had, as a percentage stand, a larger move in volatility. So is that a tell that we're about to have something more of a pullback, or was it just a little bit of a diversion there that may not really mean anything, especially in front of the FOMC announcement, which will likely trump everything that we're looking at with our technical analysis. In terms of the skew, it remains elevated, and this is one of the few remaining markers for the bearers to hold on to, that conditions might be set to move down. That's not true with the IV percentiles. These are very low. Now, obviously when you get to extreme lows, that sets up for a reversion to the mean and an increase in volatility. But just keep in mind that IV percentiles and other measures of volatility can go low and stay low for extended periods of time, and that is quite typical of bull markets. So the fact that we got a 15 on the S&P, 18 on the Russell, 16 on the Nasdaq, and 18 on the Dow is not in itself, a sign of impending bear at all. In terms of standard deviation moves, no market put in a standard deviation move yesterday. Obviously, the Friday and Thursday combination were very heavy with big up moves, actually, in terms of standard deviation price action. In terms of our regular daily report, we're still looking at bull flags. So we're expecting that pullbacks will be shallower than the thrust up, and that the bull legs are bigger. And that any pullbacks are just that, just bull flag patterns and pullbacks and minor corrections, not expecting anything bigger than that based on the current technical patterns. In terms of portfolio investor posture, the IBD status remains confirmed uptrend. Accumulation distribution score on the S&P chart is a B, and the Nasdaq is a C-. That's still somewhat concerning on the Nasdaq, but it certainly is much better than the not too long ago. This was an E and a D, so that has been improving. GMI index is a buy signal at a 6 out of 6, though that author remains in cash. Primary market condition is still weak bear, and our stock charts decision points graphs are showing mixed signals here, in that all the short term and about half the intermediate term are now bullish, but half the intermediate term and all the long term are essentially still bearish. So kind of what you get when you get a weak bear kind of condition. In terms of the intermediate term market posture, still very bullish posture, upslope sentiment. You had the bearish cluster that was present a couple days ago, and that resolved yesterday. So not much of a move down, but the bearish cluster is not present there at this time, so kind of keep that in mind. And position sizing opinions, both models are calling for 100%. Obviously, you use your own system, but you can use that as some guidance towards opinion. In terms of the intermediate term market posture, very bullish, and you see the S&P 95, Dow 95.9, Nasdaq 88.7. Very bullish across 3 of the 4 indices. The Russell continues to remain the weak cousin, and is actually in a bearish intermediate term posture, and is also down at a 68.5. Overall hedge warning status, threshold level 0+, which is a normal with some elevated risk factors still present. And indeed, we did have a couple new ones flagged yesterday. Market and decline and sharp increase warning did flag. We talked a little bit earlier about how the volatility kind of popped yesterday, and that did trigger both of those warnings. In general, the rest of this is pretty benign. We talked about skew, and this continues to be elevated. It's been quite elevated really for a couple weeks. And there's an awful lot of put side protection that's being bought. So a lot of people are being very, very defensive and buying put hedges against this rally. In terms of New York Stock Exchange new highs, new lows, where we're greater than a 3-to-1 ratio with new highs and up over 300 new highs. So that's a pretty good sign there for the bulls. Intermarket risk aversion indicators, all 5 are risk on, though this last one is just barely crossed over. So, you could call this kind of neutral to risk on. But still, all 5 are technically in a risk-on status, so that certainly is another mark for the bulls. So all in all, the bulls really control the vast majority of what we've got going here. You do have, some of these longer term indicators are still needing to be healed some more, and you have some very short term warnings that are coming in from a volatility standpoint that are warning of a potential pullback. In terms of special opinions, option income strategy, VIX is within the acceptable window, so it would be appropriate to initiate new option income strategies within the current market conditions. Is that opinion. Cover call strategies, cautiously bullish, acceptable to initiate new positions. Looking for a little bit more of a defensive move than we were last week, in that 1-to-1 ratio of out of the money and in the money strikes. Also a 1-to-1 ratio of high beta versus low beta positions. If you're wanting to be more defensive, consider legging into those cover calls with aggressive setups through out of the money put selling. And then, of course, always keep your position size in the scale that you are willing to own. That is the most defensive thing that you can do and keep yourself out of trouble. If you do get that pullback, you don't have to face a margin call or other sort of assignment in a scale that you're not really prepared to handle. In terms of put selling itself, also cautiously bullish, certainly acceptable for new core put portfolio positions. I've been putting on positions myself, put on a couple yesterday. Consider reduced position size and well out of the money puts for aggressive setups. So if you're looking at those higher beta, more volatile kinds of setups, you might want to consider legging in. And legging into the scale perhaps as well. So you maybe don't put on your whole position all at the same time. Especially if we have a pullback, you might actually find that you get some better entries on the way down with that pullback. In terms of sector specific, pretty much mostly green here with a couple exceptions. Energy, of course, and materials, have some down or neutral to them. Utilities, of course, have had some pullback of late. If you think about where we're seeing this weakness, again, consistency. When we do see weakness, we usually see it in certain sectors. We also have certain sectors that are more interest rate sensitive and could also be kind of positioning in front of that FOMC announcement. So kind of keep all that in mind. Retail, of course, has been hammered with the Walmart decision, and that continues to be the weakest sector of late. In terms of sectors percent change yesterday, generally broad market weakness yesterday with some exceptions. Consumer discretionary and healthcare were up. Telecommunications just barely above scratch. Energy, though, really took it hard yesterday, down about 2.5%. So, continue to recognize which sectors, when you have good performing markets, they tend to run the hardest to the upside. Also, at the first sign of weakness, which sectors tend to get hurt the most? And certainly materials and energy would be in that camp, often seemingly taking the biggest hit on any sign of weakness in the general market. So kind of mixed signals. Yesterday was weak, though the 5-day, 1 month, and in some sectors the 3-month are still holding up as positive. Let's see, that should be enough for today. As always, if you find what you're getting from here in the morning is helpful to your trading, the insights help you set things up, we appreciate you subscribing to us on the YouTube channel. That allows you to get notification when the videos get posted. The other thing is that by hitting that like on YouTube, it shows appreciation for what we're doing here, and we most definitely note that sign of appreciation. Other ways you can show appreciation is to retweet us to your Twitter followers, to your StockTwit followers, etc. Emails can come directly to support@falconglobaltraders.com. There are a number of opportunities also available right now. This class is being signed up, and while it will be taught live in the Chicago suburb of Schaumburg, you can also participate in every bit of that course with a simulcast to the web. More details and all the course description and so forth is at this website. And then from a Falcon Global perspective, you get more insight into what we do and how we actually take these principles that we've been talking about this morning and put them into practice with our trading, and how that is modeled. You can see more about that at this website. Disclaimers as always, hit the pause button if you need more time to review. And we'll see you back here tomorrow morning before the market opens with the Falcon Global Market Preview.